Thank you very much and welcome everybody. It's a pleasure to talk to you. I'm going to start things off with a formal PowerPoint presentation. It'll take 25 minutes or so. And so I wanted to start off just for a very quick review for some of the people in the audience that are not institutional investors. I'd ought to explain what they are. Global institutional investors, like you would see sometimes being serviced out of London or New York or Hong Kong. These are these gigantic pools of money like sovereign wealth funds or large state pension plans, university endowments, nonprofit foundations. These are the principal customers of the private equity industry. And as many of you know, they have a few key objectives, the most fundamental of which is preservation of capital. They want to keep that capital. They do want current income in terms of dividends or interest and like to have a moderate increase in their investments, as well as the ability to sell when they need cash. So they like investments that have a good deal of liquidity. And most of them are risk averse. So they're not hedge funds. They do not like to see wide swings in value. So these are the fundamental objectives of these big investors. Now, traditionally, 25 years ago, they achieved these objectives primarily by investing in blue chip stocks and bonds. Names we're all familiar with: Exxon, General Electric, Nestle. And a lot of states here in the US had laws mandating that their pension plans could only invest in these sorts of blue chip instruments. 20 or 30 years ago, as the alternative investment industry got a little more prominent, the restrictions both at the state level and the federal level here in the US got looser. And I think the same thing happened in England. And so these big institutions were allowed to invest in things that might seem a little more dicey, like junk bonds and hedge funds and illiquid real estate, and of course, private equity. Nonetheless, despite all these newfangled investments, 95% of the institutions have failed to beat a 60-40 index in the last 10 or 15 years. Kind of a surprising statistic. The 60-40 index, of course, is sort of the gold standard for big institutions in terms of a benchmark. Now, the subject of our talk today, of course, private equity. This particular investment was until recently limited in the United States to what are called sophisticated investors with a substantial net worth. And that was sort of a paternalistic view on the part of the government that these people weren't sophisticated enough to really understand the opaque fees and somewhat hidden returns of this business. But recently, the government gave the green light for retail investors to go into private equity. So here's what we're talking about today. What is it? Why is there a myth? Some of the performance aspects of the business. And as he pointed out, we'll talk about some of the enablers and, of course, why investors still do it. Most of the private equity business is leverage buyouts. And you probably have 20% in venture capital. We kind of all know what that is. Startups, young companies, often with a high-tech flavor. Growth capital would be more of companies that are sort of reaching maturity. They aren't quite there yet. So they sort of bridge the gap between startup capital and the mature money that would go into leverage buyout. Now, when you buy into private equity, the private equity company, of course, has to liquidate at some point so the investors get their money back. And, the investors hope to do an IPO or sell the company out in a merger deal to get some cash. This book focuses on the leverage buyout business, which is the majority of private equity. We've all heard of LBOs. What is exactly an LBO fund? It's a giant pool of capital. Institutional investors commit tens of millions, sometimes billions to a fund. It's a blind pool. So we don't know before we invest in the fund what the fund is going to purchase. We do have some general guidelines in the LBO business. The people running the fund are people like myself, investment banker types that don't know how to run a company, but we do know how to price and close deals and negotiate financing. And the LBO business is sort of simple. You're looking for low-tech companies that have been around for years. So they're very well established, history of making money. And that way, the fund manager can borrow substantial debt against the track record of these companies. And of course, the leverage aspect of it is that the debt to equity ratio of an LBO would be far higher than a typical publicly traded company in a similar business. Now, these funds have a 10 or 12-year life cycle. It's a no-cut contract. It's almost impossible to fire the managers once you sign up. And it has 10 or 12 years. Usually the standard is 12 because it takes a few years to run around, find companies to buy, close the deals. You then have a few years to try to improve the companies. And then finally, you need to sell them. That's a 2 or 3 year process. So for those of you, like a lot of CFA members that are stock pickers, it's a little bit like a concentrated stock portfolio where the LBO fund will have 10 or 15 companies. And of course, they own the entire company, not just, a million shares of the company. So it's a little bit like stock picking, but more concentrated, and you're buying the entire company. So of course, you have more influence on how the company is operated. Now, a popular fairy tale that you hear in the United States when the PE industry gets criticized is the PE industry says, well, we're buying these ailing companies and then we're fixing them up, and therefore we're doing a benefit for society. That's a little bit like Alice in Wonderland's story, when the real truth is that perhaps a third of deals now is simply one PE fund selling to another. And of course, as I mentioned, the companies are already profitable. There's really not much to fix up in the first place. So let's talk about the overriding theme of myth. Some of you remember these types of charts from your CFA studies. And if you look at a chart of expected returns and risk, of course, you see that the more risk you have, you're probably looking at a higher expected return. Interestingly, the private equity business claims they have lower risk, as you can see in this green circle, and higher returns. That particular sales pitch basically contradicts established finance theory and the papers of several Nobel laureates. Now let's go over the performance for a few minutes. So there's three basic performance measurements. There's the IRR, there's the public equivalent model, and then there's the total value in to total value out measurement. These are the three that everybody looks at. So let's look at the IRR for a second. Sadly, the LBO funds have not really beaten the S&P 500, at least here in the States, for the last 10 years. It's a slight premium to the LBO market, the public markets, the S&P 500. It's about flat, if you look at 15 years. I tend to look at several beginning and end dates, so you have a decent average. Now, you got to remember that these graphs assume that the PE fund managers are pricing their deals accurately, since about 60% of LBO deals closed in the last 10 or 12 years have not been sold. They're sitting up there on inventory waiting to be sold. And as we'll talk about later, there's a couple of manipulation techniques that are not reflected in these numbers either. If you look at the public market equivalent measurement, things don't look so rosy either. So the way the measurement works is you match up the outflows of cash of a private equity fund, and then you do a parallel modeling exercise where you put the same cash into the S&P 500 index. If you go over 1, that says your private equity fund is beating the stock market. As you look at these numbers, the premium over the stock market is minimal at best. I always thought it would be a lot higher when I first got into writing this book, but it's almost flat. Of course, that assumes the accurate valuation of the unsold deals. The total value in, total out measurement tool, I think that's probably the simplest to understand. So the example, as you can see here, is if you have $1 billion that was invested, and after a few years, 500 million in cash has been distributed as a dividend, and the PE manager says, guess what? We still have $800 million of value. Then your TVPI is 1.3 billion divided by a billion, it'd be 1.3. So when you look at the history of, this is the buyout industry as a whole in the US, I doubt if it's much different in Europe, you can see that the dotted line of 1.5 is pretty much the average. And looking at a holding period of 5 or 6 years on average, 1.5 does not seem like some of the claimed returns that you hear about in the media or some of the marketing pitches where the return is supposed to be 15 or 20 or 25%. Why aren't the returns higher if all these PE managers are so brilliant as depicted in the media? Why aren't they higher than 1.5? I mean, what gives? So part of the problem is that the fees are extremely high, say, compared to active money managers in the stock market or index funds. They're 3 or 4% off the top. So for those of you that are mathematically inclined, I mean, it's almost impossible to beat the stock market if you're taking out so much in fees as a manager. And as one example, I like to point out, there are a few states that will disclose the fees they are paying, both the fixed fees and the carried interest. So here you can see in the New Jersey State Pension Fund, which has a $9 billion PE portfolio, last 5 years, they paid 14% of the portfolio's earnings or principal out in fees. It's quite remarkable. Now, what are some problems with the 3 measurements I pointed out? If you've got an illiquid investment like a PE fund, you can't really sell it in the secondary market very easily, and you're stuck with it for 10 or 12 years. Most professional investors would say, look, I need some extra return over and above the public markets to compensate me for the illiquidity and the opacity of this whole operation. Some people seem to coalesce around a number like 3% of extra return, which I've seen in illiquidity studies in the past. If you were to enforce that 3% premium, 90% of the PE business would be out of business tomorrow. Let's look at some of their mark-to-market practices in the LBO industry. So as I mentioned, when a PE fund has unsold investments, companies that are privately held that have not been sold yet, how does the limited partner pension fund or endowment know what the investments are worth? Well, the PE fund managers, in accordance with maybe some accounting rules or perhaps some help from their auditors, estimate the values every year. And interestingly, they show less fluctuation in values than the stock market, which sounds a little odd since one of the first things you learn in corporate finance is when there's more debt or leverage on an asset, the value of the equity should actually fluctuate more. But they've turned common finance theory on its head. And when the stock market's fallen, the LBO funds equity falls less. When it goes up, it tends to go up less. Here's a little chart that shows this. If you look at the green line, that's the buyout business on a mark-to-market basis every year with their total return figure. So you can see it's inside the orange line, which is the stock market. This is sort of a diagram for those of us that are more detail oriented. So these unsold investments comprise a lot of the returns that you read about. And just to pick a vintage, I picked one about 10 years ago. That would be funds started in 2011. About 25 or 30% of their so-called value is in stuff they yet have to sell. So I thought 10 years, 11 years was a long time to still have companies in inventory. These things were all supposed to be sold by now. So what's the story? Does nobody want to buy them? Or are they really valuable, these investments? Now, the internal return type measurements can be manipulated. So one of the tricks, if you know the math, is you sell good deals first, the cash comes in early, and then you wait until later to sell the dogs. That improves the IRR. The other thing that's been popular recently is that some of these funds are getting to be so big they can borrow money on their own credit. They don't have to rely solely on the assets or the earnings power of the portfolio company. They'll buy a company and then drop it in a fund 6 months later. Why? Well, they're shortening the holding period, which, as you know, will enhance an IRR if things work out. So this is a chart that sort of shows you how it works. They buy the firm, then drop it in the fund, and I guess, like most of their investments, they hope to sell it. TVPI, as I said, is about 1.5 in the American LBO industry. Yet you kind of keep hearing, oh, the annual returns are 15 or 20%. If they were 15 or 20%, it just seems to me that the TVPI should be a lot higher. For example, if you use 20%, a TVPI ought to be around 3, not the 1.5 average. So there's a little inconsistency between the TVPI and the IRR. Now, you would think the regulator of the PE business would be all over this, but it's been silent on this point, as it has been on many other points. One of the big PE funds here in the States is Apollo, and their public marketing documents say they're earning 24% IRR. Funny thing is, a lot of the funds are not even in the databases. There's a few big databases that charge $15,000 or $20,000 so people can look at their statistics on PE funds, but even they will tell you we're missing a lot of funds. 40% of them we can't even get a hold of. So my view is, if these 40% are so great, how come they're not telling everybody how great their funds are? So it's a little bit inconsistent there. And one would think if those funds aren't reporting, they could actually be below average and drag down the results even further. The other interesting thing that I learned was the returns over and above the stock market tend to be in the top quartile, the top 25%. And so it's interesting that you've got a business where 75% are mediocre or worse, and yet the business still functions. Only returns that are super in the top 25. And some studies done by independent researchers have found that up to 75% of the funds say they're in the top quartile. So I liken it a little bit to the fictional Lake Wobegon of Garrison Keillor, the author, where every child is above average. So there's a real life parallel to the private equity business. So another interesting factoid is that the PE funds have a hard time repeating their performance. So if you were to have a first quartile fund in your fund number 3, you were in the top. So everybody looks at your fund 4 and says, I'm going to invest in fund 4 because fund 3 did so well. However, there's a random quality to the returns where the buyout fund manager has a tough time repeating the performance of fund 3 into fund 4. That's called persistence in the business, and there doesn't seem to be any persistence. It's random. So some investors might say, okay, assuming they read stuff like this, they might say, okay, well then I won't buy on historical performance. I'm just going to buy a brand name fund like Goldman Sachs or Carlyle or somebody like that. But there is no difference between the performance of a big name fund and a small one. They're almost the same. So the institutions, if they're going to be intellectually honest, they've got a real conundrum. Maybe they ought to just be throwing darts at a list of funds. That might be just as scientific as anything else. You think these investors, they say they have some kind of secret sauce when they buy a company and try to fix it up. But in fact, it's a random process there as well. If you look at 10 deals in an LBO fund, about 3 will go bankrupt, 4 are sort of okay, 3 would be good performers. So it's not quite as random as, say, venture capital. Maybe 1 out of 10 are great. Here you got 3 or 4. The accounting profession's been very helpful to the private equity business. They changed their rules on how you discount illiquidity through something called the net asset value expedient, which basically says an investor can value these privately held companies that can't be sold readily, almost like you'd value Amazon or Exxon or Nestle stock. It's a highly liquid thing that can be dropped immediately. So you say, well, Jeff, okay, you said how lousy PE is and misleading. Why do institutions still do it? Well, you have to look at the managers of the institutions. You have to look at human nature. Behavioral finance, maybe some people call it. If you're a manager at a big institution, like a big foundation, like the Ford Foundation here in the United States, or some big pension plan, like the State of New York Pension Fund, how are you going to score points as a manager? You don't do it by indexing. You go in and tell the board of directors, everything is so complicated. I need a big salary and a big staff because I have to buy all these exotic investments like hedge funds and private equity. So even though indexing does better from a career point of view, it's better for the manager to go into these exotic areas, enhancing career, enhancing compensation. The other thing is what I call the Stockholm Syndrome. Of course, Stockholm Syndrome derives from a bank robbery that went bad 20 years ago in Sweden. And so the bank robbers kidnapped a number of their customers for a couple of days. Finally, they were arrested and put in jail. However, the kidnapped victims refused to testify against the robbers in court because they started to sympathize with them or empathize with them. And it's the same thing in the institutional investor business. These big institutions, they go to Bermuda, they go to Mallorca for these conferences. They hang around the private equity guys. They start to like them. And they say, yeah, private equity does beat the stock market. No problem. And then, as many of you have seen, there's a lot of copycat herd mentality in the institutional investor business as well. So if this big foundation is doing it, this big university is doing it, then I have to do it. So it's hard for a myth like this to continue for so many years without help. Now you might say, well, these PE billionaires are sitting on top of the mountain. They're worth so much money. They must be very lonely at the top, but it's not. They've got a lot of friends helping them out, keeping this myth alive. So let's start off with one of the key enablers. It's called the Securities Exchange Commission here in the US. They're supposed to be the cop on the beat. They are supposed to be the sheriff in town. They have done almost no regulation of this business for 20 years. That's part of the reason it's grown so fast and so big. They let these claims of terrific performance go totally unchecked. Now, they have come out with some regulations in the last 48 hours, kind of coincides with this talk, but I'm sure they'll be so watered down by the time the PE lobbyists get through with them that it's not going to help much. There's other enablers here in the US. A lot of states prohibit the release of private equity fees. We still have very liberal interest deductions for these leveraged buyouts. And the media here, for the most part, has been an echo chamber saying how great PE is. And, that's partly because of the tendency of business to access journalism in the business media. So I'd like to close by saying PE managers, they're living the dream. High fees, mediocre returns, 10-year fixed contracts, and they have to put very little money up themselves. The so-called guardrails of media, government, so on, are not there at all. I don't think it gets any better in the city or in Wall Street than this.